Welcome to today's episode. I'm your host, Sabiha Mukadam, a FIFO service planner. Today, we are going to look at understanding credit without fear or confusion. Credit can feel intimidating when no one has ever explained it clearly. Most of us grow up hearing things like, don't ruin your credit cards are dangerous, you need credit to get credit, your score affects everything. And while those warnings may be well intentioned, they often create fear instead of understanding. So today, let's slow things down. Let's take fear out of credit. Because credit is not something you need to be afraid of. It's simply a financial tool. And like any tool, what matters most is how you use it. When used wisely, credit can help you qualify for better interest rates, rent a home, access financing when needed, and build more financial flexibility over time. But when misunderstood, credit can lead to stress, unnecessary interest cost, and limited options. So the goal is not to borrow more. The goal is to understand how credit works so you can use it with confidence, control, and clarity. One of the most important things to remember is this: credit is not extra income. A credit card limit is not money you've earned. It is money you're allowed to borrow and money you have to pay back. That sounds simple, but it is one of the biggest mindset shifts people need to make. If your credit card has a limit of 5,000, that does not mean you have 5,000 of extra money to spend. It means the lender is giving you access to borrowed money. Here is a simple example. Maya has a credit card with $5,000 limit. At first, it feels like she has extra money available, but she reminds herself that limit is borrowed money, not income. So instead of using the card for purchases she cannot afford, she uses it only for groceries and gas that already in her monthly budget. When the bills arrive, she pays it in full. That helps Maya build credit without creating debt stress. So, here is a simple rule: only use your credit card for purchases you already have the cash to pay for. Think of your credit card like a debit card with a reporting feature. You use it, you pay it off, and over time, you build positive credit history. Now, why does credit matter? Credit is not just about getting approved for loan. Your credit profile may affect whether you are approved for a credit card, a line of credit, a car loan, or mortgage. It can affect the interest rate you are offered. It may also come up when applying for a rental property. In certain situations, credit history is relevant and permitted for jobs. A strong credit profile gives lenders and decision makers more confidence that you manage financial obligations responsibly. But your credit score does not define you. It is not a measure of your worth. It is simply one part of your broader financial picture. And the good news is you have more control over it than you may think. One common mistake people make is avoiding credit entirely. And I understand why. If you have seen debt cross stress for others, it makes sense that you may not want it and stay away from credit altogether. But having no credit history can create its own challenges. No credit history is not the same as bad credit, but it can still make approvals harder because lenders do not have in much information to assess how you manage borrowed money. Here is what that can look like in real life. Priya has always avoided credit because she does not like the idea of owing money. She has no credit cards, no loans, and no accounts reporting to the credit bureaus. When she applies for rent, when she applies to rent her first apartment, the landlord asks for a credit check. Priya does not have bad credit, but she also has very little or no history for the landlord to review. That can make the application harder. A small, well managed credit card or a phone plan in her own name would help her build a track record over time. The key is this: you do not need to take on debt to build credit. You simply need to show that you can use credit responsibly and pay it back on time. A small, well managed credit history is usually better than no history at all. So, how does credit actually work in Canada? Canada has two main credit bureaus: Equifax Canada and TransUnion Canada. These bureaus collect information from lenders and create your credit report. Your credit report is the detailed history. It can include your credit cards, loans, line of credit, payment histories, balances, credit limits, collection, and credit inquiries, or any liens on your account. Your credit score is the summary number created from that information. Think of your credit report as the full story and your credit score as the headline. Credit scores in Canada often range from 300 to 900, with higher scores generally viewed more favorable by lenders. But here's something very important. There is not just one single score that every lender uses. The score you see through your bank or a free credit monitoring app is helpful, but it may not be the exact same score as a lender uses when making a decision. So use your score as a guide, not as a permanent label. Now let's clear up some common credit myths. Myth number one: checking your own credit score lowers it. This is a false statement. Checking your history is considered a soft inquiry. It does not hurt your credit score. You can check your own credit report or score regularly without losing points. Myth number two: you need to carry a balance to build credit. This is a false statement. You do not need to pay interest to build credit. Paying your statement in full every month can help build excellent credit without interest charges. Carrying a balance does not help you, it just costs you money. Here is a quick example. Sophia hears that she needs to leave a small balance on her credit card to build credit. So she lets 300 carry over each month and starts paying interest. Later, she learns that carrying a balance is not required to build credit. What matters most is using the credit card responsibly and paying on time. So Sophia changes her system. She uses the card for planned purchases only. Then she pays the statement in full every month. She continues building credit without paying unnecessary interest. Myth number three: being added as an authorized user always builds your credit. In Canada, this does not always help you build credit in your own name. It may help you practice safe card use, but eventually you generally need accounts reported under your own name to build your own credit history. And myth number four: closing old credit cards is always a good idea. Not necessarily. If an old credit card has no annual fee and you can manage it responsibly, keeping it open may help you preserve your credit history. So, the longer the credit history, the oldest card usually should be kept open. For example, Jason has an old no fee credit card he has not used in months. He considers closing it, but then he realizes it is his oldest credit account. Instead of closing it, he keeps it open and uses it once every few months for small purchases. Then he pays it off immediately. Because the credit has no annual fee and he can manage it responsibly, keeping it open helps preserve the length of his credit history. So remember, your first credit card, if it's no fee, keep it open. So what actually affects your credit? There are five main habits to understand. The first is payment history, and this is a big one. Lenders want to know whether you pay your bills on time. Even one missed payment can hurt your score, especially if it is reported as late payment. The best habit is simple: pay at least the minimum amount by the due date and pay the full balance whenever possible. Paying at least the minimum protects you from having late payment history. Paying the full balance helps you avoid interest. The second factor is credit utilization. This means how much of your available credit are you using. For example, if your credit card limit is 1000 and your balance is 300, you're utilizing 30%. As a general rule, try to keep your credit card balance below 30% of your limit when your statement is issued. Think of your credit limit as a breathing room, not spending room. Here is what it can look like. Daniel has a credit card with 2000 limit. One month his balance reaches 1600. Even if he plans to pay it off, the high balance may make it look like he's relying heavily on credit. To manage this, Daniel makes a mid-month payment before his statement is issued. He brings the balance down to 500. That keeps his utilization lower and shows more responsible credit use. The third factor is the length of credit history. The longer you have managed credit responsibly, the stronger your profile may become. This is why older accounts can help. Credit rewards consistency over time. The fourth factor is credit mix. Lenders may like to see that you can manage different types of credit, such as a credit card, student loan, or a car loan, or line of credit, or mortgage. But that does not mean you should take on unnecessary debt just to create variety. Credit mix can develop naturally over time. Focus on what you actually need, but having a good mix, but just having a credit card gives you basic credit not really a full credit history. And the fifth factor is new credit inquiries. When you apply for credit, the lenders may perform a hard inquiry. One hard inquiry is usually not a big deal, but many applications in a short period can make you look financially stretched or credit hopping. So apply intentionally, not because of impulse offers, store discounts, or pressure at checkout. A quick note on buy now, pay later plans. These can feel convenient because they split purchases into smaller payments, but they also can create confusion. A few small payments may not seem much at first, but several plans at once can quickly strain your cash flow. For example, Emma uses buy now, pay later for a jacket, then again for concert tickets, then again for furniture. Each payment seems small on its own, but by the next month, she has several automatic withdrawals coming out at once. She realizes the issue is not one purchase, it is the combined effect of multiple small commitments. Before using buy now, pay later, Emma no fee credit card can be a good first step. Use it for one or two predictable expenses like groceries, gas, a phone bill, or a subscription. Then pay it off in full every month. Here's example. Aiden is 19 and has never had a credit card before. He applies for a no fee credit card with a $1,000 limit. Instead of using it for random purchases, he puts one small recurring expense on the card, his monthly phone bill. He sets up automatic payments so at least the minimum is paid on time. Then he pays the full balance each month. After a year of consistent payment, Aiden has started building a positive credit history without carrying debt. Now, you can set it up so that the whole balance is paid up in full as well. If you're not approved for regular credit card, a secured credit card may help. With a secured card, you provide cash deposit upfront, and that deposit usually becomes your credit limit. You may also consider having a phone plan in your own name if payments are reported to the credit bureau, and if you rent reporting services may be worth exploring as well. Now, usually, if your phone bill is on an account, then they are reported to the credit bureaus. For example, Omar rents an apartment and pays his rent on time every month. Because he does not have many credit accounts, he explores a rent reporting service to see whether his rent payment can help build his credit profile. Before signing up, he checks whether there is a fee, he checks which credit bureau receives the information, he checks whether his landlord needs to verify payments, and he checks whether missed payments could also be reported. For Omar, rent reporting may be useful because he's already making the payments consistently. Rent reporting can be helpful, but it's not magic. It's just one possible tool. Now, if your credit has already been hurt, I want you to hear this clearly. You can rebuild. It may take longer, but you can. Damaged credit history can feel discouraging, but it is not permanent. Start by bringing accounts current where possible. If you cannot catch up right away, contact the lender and ask what options are available. Then focus on stopping new damage. That may mean pausing new credit applications, setting up automatic payments, reducing unnecessary spending, or creating a simple bill calendar. If your balances are high, work on paying them down gradually. If you have collections, please do not ignore them, especially when you are disputing a bill with someone. Still make that payment. Please review the details, make sure the debt is valid, keep written records, and get any agreement in writing. If you're disputing it, pay it and then dispute it. Here is a real life example. Marcus misses a credit card payment after switching banks and forgetting to update his automatic payment information. His score drops and he feels discouraged. Instead of ignoring it, he calls the card provider. He brings the account current. He resets his automatic payment and he adds a reminder to his calendar 3 days before each due date. The missed payment is frustrating, but it does not define his entire credit history. What matters is the system he builds from that point on works. If needed, a secured credit card can help you restart. Use it lightly. Now, this is usually in cases of bankruptcy, collections, big collections, and you want to rebuild credit history. That's when you do this. Use it lightly, pay it on time, keep the balances low. Credit rebuilding does not happen overnight. Progress is measured in months and years, not days. But every one time payment matters. So, what should you do today? Start with 3 simple steps. First, check your credit. Log into your online banking or use a free credit monitoring platform to see what information is available to you. Now, a lot of banks, online banking have the credit check options now, so please go and check there. You don't have to pay for a service. Then review your credit report for errors. Your score matters, but your report tells the full story. For example, Leah checks her credit report and notices a credit card account she does not recognize. She contacts the credit bureau and the lender to dispute the information. It turns out the account was reported in error. Checked her report, she caught the mistake early and was able to start correcting it before applying for mortgage. That is why checking your report matters. It helps you check for fraud and also helps you make sure you're paying all the bills on time. Second, set up one automatic payment. Choose one important bill like a credit card or a phone bill and set up automatic minimum payments. This creates a safety net. And third, use credit like a credit card. Before using your credit card, ask yourself, do I really have the cash to pay this off? If the answer is yes, the purchase may fit your plan. If the answer is no, pause. That one habit can protect you from unnecessary interest and long term debt stress. Your credit story is not defined by where you start, it is shaped by what you do consistently. Every on time payment, every lower balance, every avoided impulse application, and every smart decision moves you forward. You do not need to be perfect. You need a simple system. Pay on time, keep balances manageable, check your report, use credit only when it supports your real life. You're not behind, you're building. And with clarity, consistency, and confidence, your credit can become a tool that supports your future instead of something that causes fear.